This is what I saw when I opened my Financial Times app today. A suggestion that the stock market is in freefall. And this isn't even the most aggressive headline either. The Independent suggests there's been a wipeout in Wall Street. And the Express suggests there's total chaos in the stock market. The reason for these dramatic headlines is because of a big one-day decline in the US stock market, with the S&P 500 having its worst day since December 2022, falling 2.3% on Wednesday the 24th of July. This kind of decline and the headlines which go along with it tends to drive a lot of panic, particularly among beginner investors who can end up panic selling out of fear their portfolio value could go even lower. And I've seen a few social media outlets and even other YouTubers play on this fear, almost suggesting that we should all panic. I'm not a fan of this fear-mongering. It's annoyed me in the past, but I've never done anything about it. So this time I thought, let's create a video going through why panic selling is the opposite of what I'm going to do. Explain the reasons why my strategy is going to stay exactly the same and why it will stay the same even if this market decline becomes a crash. To achieve this, we'll split the video into two parts. Firstly, going through what's actually happened to the markets, and secondly, going through why this decline won't change my investing approach. So let's start the video by going through what's happened. The day before I recorded this video, the US stock market saw big declines, with the tech-heavy Nasdaq index falling 3.65% and the S&P 500 falling 2.3%. These declines were mainly driven by lackluster quarterly earning reports from Tesla and Alphabet, leading to a sell-off of big tech stocks. For example, on Wednesday, Alphabet stock fell by 5.03%, Nvidia fell by 6.8%, and Tesla fell by a whopping 12.3%. All of these falls have negatively impacted US and global indices, given that these stocks make up such big proportions of these indices. And on paper, this performance doesn't look good. And if this happened when I started investing a few years ago, I would have probably panicked and been tempted to sell to avoid further losses, particularly as I was investing in individual stocks at that point, which tend to be exposed to big swings. However, now my strategy is very different. My plan is to continue investing in my portfolio every month, irrespective of what the market does in the short term, irrespective of if this market decline continues. So let's move on to part 2 of the video, exploring why this is the case. My investment strategy is focused on the long term. I back companies and funds I think will do well over the next 10 to 20 years, with the hope that when I want to take the money out, the value of my investments will have significantly increased. I'm not too worried about what happens to the value of my investments in the short term, whether that's today, tomorrow, next week, next month, or even next year. Market movements in the short term, whether that's increases or decreases, don't really bother me. And this recent market decline is just another short-term market movement to me. In the short term, markets tend to be volatile, and historically this has always been the case. Markets have always ebbed and flowed based on people's emotions and market sentiment. In fact, this year alone we've had 5 declines of more than 2% in a single day in the Nasdaq index. And similar patterns are evident historically over individual years, as markets tend to have big swings upwards and downwards over individual years. For example, between 1972 and 2022, there was 29 occasions where the MSCI World Index fell by at least 10% in value in a single year. However, this doesn't tend to happen over longer periods. Over periods of 5 years plus, broad market indexes tend to do very well. This time frame has tended to historically be long enough to ensure that markets have the chance to ride out any storms and make a good return. For example, over the past 5 years, the Nasdaq is up by 137%, the S&P 500 is up by 79%, and the FTSE All World is up by 51%. Of course, these examples are biased, as the last 5 years has been very good for the stock market. But even if we consider the average returns over a longer historical time frame and compare this to the average returns of putting your money in a savings account or in bonds, then we can still see that the stock market has historically provided the best means to grow your money out of these assets. This graph shows that over the past 5, 10 and 20 years, the average returns for cash savings have failed to keep up with inflation, and it's only over periods of at least 20 years in which bonds have provided returns beating inflation. By contrast, stock market investments have delivered inflation-beating returns over all the periods highlighted in this graph in terms of average yearly return. Of course, past performance is not an accurate predictor of future returns, but I think this illustrates why a long-term outlook is key to my own investing strategy, and why I won't change my strategy based on the movements of the market in the short term. If I was a trader trying to beat the market by buying and selling over short time periods to make a profit, then maybe I would have a different approach. But I'm not a trader, I'm a long-term investor, and my long-term focus is the main reason why short-term market movements, the market movements we're currently seeing, won't change my plan. The other key reason why I won't sell my investments during periods like these, and why many investors actually buy more during periods of decline, is the fact that the market's best days tend to follow its worst days. And I definitely don't want to miss out on the market's good days, as this could make a huge difference to my overall investing returns. This graph shows that if you missed out on the 10 best days of the S&P 500 over the 20-year period between 2002 and 2022, your return would be half of what it would be if you stayed invested on these days. And if you missed out on the 60 best days, your return would be a whopping 93% lower. This shows the problem with panic selling in moments like this, in that it not only crystallizes losses or very small returns, but it also puts you at risk at missing out on the best market days. I don't want to miss out on the best market days, and my strategy is focused on investing in the long term. And I hope in this video I've explained the reasons why I have this strategy. If you want to check out my portfolio and its recent performance, I have a video around here. But for this video, I'll leave you with a quote from Benjamin Graham.